But I would suggest to you that it will take a 75% devaluation in the purchasing power of the dollar to make our nominal obligation serviceable. You'll get through it fine. You add value. I'll get through it fine. I add value. A pensioner on a fixed income,
Yeah.
who is spending $4,000 a month today, needs to know that he or she will need to make $16,000 a month 10 years from now to sustain the same standard of living that $4,000 sustains today. And that's a truly ugly number.
What's up, everyone? I've got something special for you today. In this conversation, Rick Rule sits down with Lynette Zang for a surprisingly deep dive into where we may be headed next. Rick has been in the precious metals and resource markets for over 5 decades, and he's drawing uncomfortable parallels between today's environment and the 1970s, from inflation and debt to underinvestment in commodities. But what really caught my attention? His warning about derivatives and the hidden risks most investors never even think about. If you care about gold, silver, or just understanding how fragile the financial system might be beneath the surface, you'll want to hear this perspective all the way through, especially the part where he explains why even he can't fully quantify the risks. Before we jump in, tell me in the comments where you're watching from. I always love seeing how global this community really is. All right, let's get into it.
Long time, very well respected, and I really appreciate you being here. But I have to ask you, you've lived through a lot of financial cycles. Does this one seem similar to ones you've had in the past, or how might this be different?
If you give me the use of the word similar, then yes.
Okay.
It
Similar.
reminds
Chaos.
me the most of the 1970s,
Yes.
in the sense that we're coming off 20 or 30 years of fairly benign economic climate. I'm not suggesting, by the way, that World War II was benign, but the post-World War II period from 1945 to 1970 was really fairly benign. US dollar hegemony, declining interest rates, strong economic growth. And underlying that was an investment focus on industries that were non-extractive. The growth of the United States is an example.
Mm-hmm.
So the Nifty 50 is an example in the 60s attracted a lot of investment attention. There was not a lot of investment attention paid to underlying materials. Well, the use of those underlying materials was growing. There was a coiled spring aspect to it. At the same time, the economic climate in the late 40s and the 50s, in fact, most of the 60s, was so benign that people forgot to be afraid. They forgot to understand what was happening to the federal budget, what was happening to tax rates, what was happening to underlying wage and cost explosion. And that all came to a head in 1970. I think that's very similar to the circumstance that we face today, Lynette. If you look back at the period 1982 to 2022, I suspect that when history is written, that will be the most benign investing epoch in human history.
It's kind of interesting that you say that. And then also, like you said that they weren't really paying attention to the underlying materials. Are you talking about like commodities like lumber and
Yes, absolutely. Absolutely. Our society had been underinvesting in productive capacity around raw materials literally since the Depression. We used a ton in World War II. Came out of World War II unconstrained. We were more worried about a depression or a recession than we were about economic growth. And the consequence of that is that we underinvested in productive capacity, even as we were using up.
This is the moment you need to slow down and really listen. When Rick said this reminds him of the 1970s, that is not casual commentary. That decade destroyed purchasing power. The US dollar lost roughly 75% of its value, and gold didn't just rise, It exploded more than 20-fold. You need to understand what's really happening here. He's describing a cycle. Decades of underinvestment in commodities, rising demand, and then inflation that catches everyone off guard. Today, we've had years of easy money, underinvestment in raw materials like copper and energy, and now global demand continues rising. History doesn't repeat perfectly, but it rhymes. If we even experience half of what happened in the 70s, gold and silver are not just nice to own, they become financial protection. This isn't fear, this is pattern recognition.
But I would suggest to you that it will take a 75% devaluation in the purchasing power of the dollar to make our nominal obligation serviceable. You'll get through it fine. You add value. I'll get through it fine. I add value. A pensioner on a fixed income, who is spending $4,000 a month today, needs to know that he or she will need to make $16,000 a month 10 years from now to sustain the same standard of living that $4,000 sustains today. And that's a truly ugly number.
Yeah. Well, there's something else that, and I hadn't really ever thought of it this way. So this is a reasonably new thought process that I was going through because, of course, being American, you don't really want to think that our government would do an overt confiscation, certainly of our wealth. And they certainly have in this country many times. But the last time was 1971 when Nixon defaulted on Bretton Woods. So all of those governments whose gold that we were holding with the promise to convert the dollars into them and they could take it back, nobody ever says that's a confiscation, but every country has a gold revaluation account. The U.S. is not alone in the unpayable level of debt or promises. And there's no way to even know unless you might have a way, but I haven't figured out how to know how many derivatives are against all of this stuff and what's really happening in that market after 15 years of ZERP. But I'm convinced, and you say however you think anyway, you're going to anyway, which you should. But I think that we're transitioning into a brand new system and that these transitions like the 70s are not easy for most people. What are your thoughts? Will we end up in a confiscation more overt? Because price manipulation is a confiscation, taxation, inflation, all of that is a form of confiscation.
The most honest answer is I don't know. The more nuanced answer is that if politicians steal from you and I overtly, there are costs to them.
Really?
Yeah.
I'm sorry, Rick. I haven't seen too many of those costs. But
well, there are prospective costs.
Yeah.
If they came and said, we are only going to let your IRA invest in government securities, I think they would become acquainted with the fact that there were 400 million guns in private circulation in the U.S. If they came to steal your gold again, I think there would be real political costs. If, however, they persist with deficit spending, if they persist with inflation, if they persist with artificially low interest rates, which subsidize spenders at the expense of savers, there are more spenders than savers in society, and they get rewarded for that same material. They get rewarded for those policies of wholesale theft, and they get punished for retail theft. If you assume that people seek rewards and they minimize risk, then Congress people, understanding that they're extremely popular and they get reelected, if they inflate, if they spend.
This is where it gets serious. When he talks about a 75% devaluation being necessary to service debt, that's arithmetic. As of January 2025, U.S. federal debt is over $34 trillion and rising. Historically, governments reduce that burden one of two ways: austerity or inflation. And here's the part that most people miss. Rick said he studied derivatives for 40 years and still couldn't fully understand them. That should stop you in your tracks. In 2008, complex financial products froze liquidity overnight. He's not predicting collapse. He's highlighting unquantifiable risk. And when risk cannot be measured, prudence becomes your strategy. That's why holding liquidity in dollars but saving in gold makes strategic sense. It's not about panic. It's about positioning yourself so you're not exposed if confidence suddenly cracks.
These high yield ETFs have literally trillions of dollars in them, and they're extremely liquid. I mean, extremely liquid.
Moment.
The problem is that what they own is extremely illiquid. And if we came to a point in time where the ma and pa owners of these things began to express concern about credit and sell them, the managers of these funds, in order to fund these extremely liquid redemptions, have to sell extremely illiquid junk bonds. That's a run on the bank. Well, we had a saying when I was a young broker. I did a lot of high yield stuff in the old days, back when high yield was cheap. And we called an illiquid bond an owl bond. What that meant, Lynette, was when you called your broker to say sell, he or she would say, to who? To who?
I love that. I'm going to use that, Rick.
Please do. And the thing that really scares me aside from derivatives, I mean, the thing that scares me as being the pin that could pop the balloon is this proliferation of what should be private credit in public ETFs among people who own it simply for the yield without any understanding whatsoever of the credit risks that they're running.
So when you're talking high yield, because people hear that, would you define for our viewers what high yield is, and also the level of leverage that has you concerned in these ETFs?
I think for the average investor, any debt that isn't investment grade, I mean, isn't triple B or better, probably any debt that isn't investment grade, and also no, I wouldn't include publicly traded because I'm okay with prime rate bank loans. I'm okay with bank loans to, as an example, Exxon. That doesn't bother me. But the triple C's to Schlepp, Schmuck, and Schmo Automotive or Red Lobster. People own these ETFs that are agglomerations of sub-investment grade credits. And those credits were established by Wall Street to benefit the issuer and generate a fee. They were not constructed for the benefit of the buyer. The buyers are, in very ugly parlance, yield whores. They chased 50 or 60 basis points or 100 basis points and gave up completely any focus on credit quality.
Yep.
The second concern is, I think, duration. If you believe, like most of your listeners do, that inflation is expressed by the CPI, I think you need to reorganize your thinking. The CPI would have you believe that the underlying rate of deterioration, the purchasing power of the US dollar, is 2.7%. Any of your listeners who use their common sense and compare a basket of goods and services that they acquired in 2020 against the price levels of that same basket of goods and services today will understand that 2.6% is fallacious. Besides which, the index, when it's inconvenient, doesn't include food or fuel. If you could see my total self, you would see that lunch is important to me. So that index is less relevant. And the index also doesn't include tax. Now, I would suggest, Lynette, And I think that your viewers, if they examined it, would agree that the real underlying rate of deterioration of the US dollar is more like 8%.
This is the warning shot. High yield ETFs packed with illiquid junk credit. That's the pressure point. If retail investors rush for the exit, fund managers must sell assets that can't be sold easily. That's how liquidity events begin. And when Rick says real inflation feels closer to 8%, look at your own expenses since 2020. Groceries, insurance, housing, the numbers tell the story. Now combine that with 10-year bonds yielding around 4%. That's a negative real return. And here's the mindset shift. He said, don't just save in dollars, save in assets you understand. Gold isn't a speculation, it's monetary insurance, especially when debt levels are mathematically unstable. This isn't about doom, it's about discipline, preparation, ownership. So what do you guys think of this? Leave your thoughts down in the comments. Please like and subscribe, and I will see you in the next video.